Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, November 1st, 2023, and this is Blockhead Traders Weekly. In this week's episode, earnings season for Q3 is starting to wind down, and so I did a little screening on a couple of earnings plays potentials that are upcoming, and I want to take you through some of the methodology that I was looking at. As you know, earnings trades are one of my favorite type of trades to play. I picked out three that I have my eye on. That is Goodyear Tire Company, VERV Therapeutics, and Alteryx. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, you can pick this up in an audio format wherever you get your podcasts. And if you can't find it there, let us know and we will get it there. All right, in this week's episode, I want to take a look at earnings trades again. As many of you know, this is one of my favorite types of trades to take because you get a lot of instant gratification overnight, and they can be large, ripe things for volatility contraction, which is when you're selling premium, you're really looking for that volatility contraction. That volatility comes with a price, and so we want to sell that volatility, knowing that that volatility will most likely fade away as soon as the binary event is over, and then we can buy back our position to close it out when volatility is much lower and much cheaper, and effectively profit on the difference between what we sold that volatility for and what we bought it back for. As Q3 earnings are really winding down, I want to take a look at my earnings screener that I have. So let's hop over to my earnings screener and we'll just, briefly review. This is the same criteria that I really look at for all the earnings trades. So if you've paid attention to past episodes, this will be a refresher for you. If this is the first one you've listened to, then here we'll kind of run through very quickly the screener. The first variable up here is the closing price, and I really like my closing prices to be above $10. And really for this, I'm not setting an upper limit, although because I typically don't put protective legs on my earnings split trades, I want to keep that kind of below 100, maybe $150 a share. We'll see, that's kind of the upper end for my threshold of risk. But nonetheless, this is not limited on the upper bounds just because I want to see what the screener picks up. Next one down is volatility index. This is the spot volatility of the underlying. And for what I have found to be relatively successful is anything under 30% spot volatility, usually the juice isn't worth the squeeze. So I pretty much start my thing at 30% spot volatility, and you'll see a lot of the spot volatility that I end up playing will be much higher, above 60, 70, 80% spot volatility. That's really where it gets a little bit sweeter for me. But it's a screener, so I'll let additional filtering come down later, but let's cast the net a little bit wider to begin with. Next parameter is IV percentile. And for this initial, I'm not going to set that threshold. You can see it goes from 0 to 200. Normally IV percentile just goes between 0 and 100. So this filter is wide open and it's not tuned. So effectively, you don't really need this parameter, at least for the first cut. I use this screener for other things, so I could narrow it down. But again, you'll see I'm going to sort by this stuff, so not so important. Next thing is earnings. I want the earnings to be happening soon. And so you can see here I have this earnings announcement, has earnings anytime in the next 8 bars. And the current bar setting here is days. So this basically translates to 8 days. So earnings announcement sometime within the next 8 days. That lets me see, any earnings trades that are left in this week, but it's predominantly for the earnings trades next week. I like to have a lot of volume on the shares that I'm trading, because that volume typically means liquidity. Liquidity means better fair pricing. So I'm pretty much looking at only the past 5 days of moving average to be above, in this case, 1 million shares a day. So I use a moving average over the 5 recent trading days because I don't want to get these weird anomalies of, oh my gosh, the past day there was just this massive volume, but historically it doesn't have it. So that's why I try to do the moving average. But you'll see when I start looking at things what I'm narrowing down to. Now, I don't want to fill up my filter with earnings that basically happen today or tomorrow because most of those are too late to play. And so I'll say, okay, it's in the next 8 days, but it is not earnings in the next 2 days. So this basically takes me to my 2+ days to 8 days out window. Should be what shows up in my screener. And so when I scan for that, I've got my filter list right here. And the first thing that I do is I filter this list by IV percentile. So this is the rank of where is the volatility relative to the past year. And so an IV percentile of 100% basically means it is as high a volatility that has existed in the past year. So never in the past year has the volatility been higher than it is right now. So I typically like to start up there at, what is the highest IV percentile and kind of work my way down. Most of the time, I am not touching anything that has less than an IV percentile of 50%. Why is that? Because we want that volatility to be extended. And so, 50% volatility just means average. And we really want that volatility to be extended to the high side because the higher the volatility goes, the more premium there is, and the more stretched it is to that upper end of 100, the more likely that we're going to get a volatility contraction. And so that's where I'm really biasing a lot of what I look at towards the upper end. And so most of the time I just kind of sort the list to see where does everything fall and go from there. And I'm going to show you a couple things before we jump into each one of these, and then I'm going to circle back and we're going to jump into the ones that I happen to have picked out. The other piece that I'm going to quickly look at is two columns along the lines with the IV percentile. The one is right next to IV percentile, which says vol index. This is the spot volatility. So this is what is the volatility right now. And in this case, Goodyear Tire is showing about a 62.95% volatility. That basically means the spot volatility is about 65 or 63%. And in the past year, it has always been less than 63%. So why does spot volatility matter? Because if you recall just a little bit ago, I said around 30% spot volatility, and it's just not a lot of premium return. So this is above that. It's at 63%. It's not crazy high. It's pretty decent. Now it is crazy high for this particular underlying, which is why there's an IV percentile of 100. But this likely means there will be decent premium there. So this is what I'm going to look at. The next thing I look at is the volume column. I'm looking for heavy volume, high volume. This is not the average that I talked about. This is just today's volume. So today, 6 million shares of Goodyear Tire and Rubber traded. So this is well above that million threshold. Perfect to look into. I'm going to kind of move down here, top Callaway Golf. This is interesting. Again, it's 100. It's got a 75%. This might be a good one to look at. It's not one that I happened to pick out because, Goodyear was at the top, but they're both 100. They're both almost the same underlying. They're 2 cents off a piece. So top Golf Callaway could be something there. But like I said, one of the other things I want to look at is this spot volatility. And holy guacamole, what is this? 228% spot volatility. Now, this is interesting because when you start getting above 100% in spot volatility, you start getting some really rich premiums. And so this kind of perks my curiosity. I checked the volume here. We're at 1.4 million shares traded today. An underlying price of $11.75 with an IV percentile of 94, which basically means 94% of the time it's been lower than this. Only 6% of the time has volatility been higher. This one is definitely going to hit my screener marks. And so, one of the other things I've noticed about a lot of these is Gilead Science, this Perigo, I don't know what they are, but I started looking at some of these and there's a lot of healthcare names. VERV Therapeutics is like a healthcare pharmaceutical type thing. I don't normally care for those. They can be extremely volatile, but they also can be extremely dangerous because of that volatility. And so I kind of like to also screen for names I kind of heard of or know of, or at least a sector that's different. And so, I've got the Goodyear Tire and Rubber. Okay, I have heard of that name. That's definitely not in a pharmaceutical space. We've got this one, all VERV Therapeutics, a little bit pharma. Alteryx is jumping out to me. Why does this one jump out to me? Again, an IV percentile of 90 some percent, spot volatility of 93%. So getting close to that 100. So that is interesting. And so, a million shares, little bit kind of on that threshold of where I'm looking. So the volume, not that great. So I'd look at the spreads to see, where they fall. So the first thing I'm going to do here with Goodyear is I'm going to send this over to the option chain explorer that I use. And so we'll pop that over into my option chain explorer, and then we'll take a look at what we're dealing with here. Now, one of the things that I had clicked on before I moved over here is winter earnings. Earnings for Goodyear are November 6th after the bell. All right. So that means I want to do the option expiration that is leading up to that Friday, the Friday after earnings, because we want that uncertainty. We want that binary event to be included prior to the expiration. And so if I look at all of these different option chains, you can see the expiration dates. Over here is the volatility of that option chain. You can see the ones that expire this Friday, November 3rd, are at 64%. Then you jump to November 10th, which are 88%. Then you fall back down to 76%. So a lot of times, if you look at the option chain and you never check the earnings of the stock, you likely can predict which week actually has the earnings, because that particular week's volatility will be higher than all the others. And sure enough, that is true here, with the November 10th having the highest percentage of volatility of November 10th. Checking earnings, it's a November 6th. So this is the expiration of the week of earnings. And what I typically like to do is come down to the chain to make sure that we have pretty decent liquidity here. We're judging that by the bid-ask spread. Now, the market is closed, so it's kind of hard to gauge some of this, but usually if it closes in a liquid state or close to it, it's going to be good enough. And so I'm going to target about a 16 to 20 delta because I try to do a strangle first. Because volatility is so extended, most of the time you're looking for a nothing burger out of the earnings announcement and that contraction. And so, playing the earnings on both sides, burning the candle at both ends is an approach I like to take. So here I'm going to grab this 1050 put. So you can see here that is a 19 delta. And so I'm going to throw that down there. And then I'm going to come over to the call side and I'm going to look for a similar side on the call. And we've got a 16 delta and a 24 delta. Now, because I'm playing both ends, I'm not so sure I'm that comfortable with the 24. That's a little bit aggressive, particularly on the call side. If I'm going to step up my delta numbers, I'm probably going to bring the put side up to a higher delta, just because in the grand scheme of things, generally stocks go up. They don't necessarily go down. I mean, they can go down in lots of periods there, but over time, they're going to trend to the upside. And on the call side, you basically have no protection. So your losses are unlimited on the upside. So for earnings, I like to back down a little bit, and I'll stick with that 16 delta here. So let's add that 16 delta in. And so what we got down here, you can see this trade. We got collecting 32 cents. Now this is for 100 shares, so this is effectively $32, risking 150. Now I'll kind of flip over here to the risk profile picture here, and I like to set this to the expiration. So they're going to expire on the 10th. So I pick the 11th, and this shaded range is basically the expected move based on all the numerical values in the option chain. And then this blue line is showing my P&L based on the strikes that I chose. Now, I really like to have my strikes outside of the expected move, because this means that, hey, one standard deviation is going to stay in this gray shaded box. And then basically that is also in between my strikes, staying out of the money on both sides, equaling maximum profitability. Now, in the particular example here, I'm risking 150 for my risk tolerance. I probably would take this up to about $1,500 is where I like to target some of my buying power reductions. And so this simply is just taking the number of contracts as part of this up to 10, and that just multiplies everything by 10. So I'm effectively collecting $320. I'm risking $1,500 here. I should say I'm risking more, but it's consuming $1,500 of buying power. When I say risking more, it really depends on where this thing goes. You can see if I kind of slide this thing over, if the stock dropped to $9, I would be losing $1,200. And so, this buying power does not actually equal your risk, but it is a measure of how much that's going to hit your portfolio and how much that's going to impact the capital that you have in there, because it will tie up this buying power in your portfolio. So summarizing the Goodyear tire trade, this is a pretty run-of-the-mill earnings trade for me, because of the spot volatility, because of the IV percentile, because of the name of Goodyear, where the chart is. I know I didn't show you the chart because I don't typically necessarily look that closely at the chart. I really focus on that expected move, where that is relative to the percentages. One of the things that I have on that expected move, and you can see it here because I screenshotted it, you'll have yellow bars. Now those happen to line up almost exactly on the expected move. That doesn't normally happen, but those yellow bars on the outside, the two outermost dotted yellow lines, that is plus 10% and minus 10% off of the current price. The dotted line in the middle there, the yellow dotted line in the middle, is the current price of Goodyear tire and rubber. And so that's showing you, hey, this is where a 10% move would take you on your price chart. Now, the axis there is actually the price of the underlying. And so you can see the expected move is about plus or minus 10%. And then you can see my strikes are even outside of that. So we're talking a move greater than 10% to even start to challenge my strikes. And if we kind of look at that, like I said, we targeted the 15 to 20 delta strikes. And that happened to be, we got pretty close to about a 16 delta, I think, on both sides. That was the $10.50 put and the $13.50 call, bringing 32 cents or $32 a contract. I decided to bounce that up to 10 contracts. You can size that to your risk tolerance, your buying power in your account. And so if you had a smaller account, maybe you just do one contract and you're going to pick up $32 and it's going to take $150 in buying power. Maybe you have a massive one and you want to take that to 100 contracts and, collect $3,200. Now you're going to be risking, $15,000, not risking. You're going to put up buying power of $15,000, but maybe that's what's appropriate for your portfolio. For me, I would take those contracts to 10, but no matter what you pick, the percentage of upside is going to remain the same. And I calculate this based on the buying power consumption. Remember, this is not risk. Your risk is greater than this. However, by looking at the return on your buying power here, we're looking at a potential of a 23% upside, collecting $320, putting up about $1,500 in buying power. So what's next? Now, this is where I want to jump to the VERV Therapeutics. Now, an interesting thing here is we're not entirely sure of when VERV Therapeutics earnings are. They have a little question mark here that says earnings on 11/7 before market, but the question mark means it's not confirmed. If it is confirmed, you get this, at least in the TD Ameritrade Think or Swim, you get this little light bulb that says earnings are here. It's actually confirmed. This one is not confirmed, but this is interesting enough for me because of this 228% spot volatility. Like I said, that is extremely rare to see a spot volatility like that. So, I shouldn't say rare. It's uncommon. It's not, there's usually something crazy out there laying around like that. So let's go ahead and we will send these over to the option window. So I'll send that over there, and then we'll hop over here and we'll take a look at the option chain. Now, the first thing you notice here is we've got only a few sets of options, no yellow things, no weeklies. These are just standard monthly option chains. So you got this one at 300%. Earnings are likely in that window sometime before November 17th. That kind of jives with the estimation of November 7th, even though it's not confirmed. So this is the chain I'm going to play with. Here we've got something interesting. So we want to target, remember my thinking, I'm targeting 16 to 20 delta. Well, on the put side, we got 15. That's a little bit lower than I normally like to go. It's okay. That's down at the 750 strike. So let's leave this just for a second and say, okay, that's close to 16. Let's roll with it. Then we'll come over here to the call side. 25 is the upper end of that. So we might take 25. Now, this is going to pick up, 80 cents and 30 cents, 279. Let's go ahead and take a look at this. Let's expand this. Now, this is November 17th expiration. So let's go ahead and set the expected move here to bump us out to November 18th. Now, here is something interesting. Okay. Now, I took those 18 deltas, but look at this chart here. This is really what happens when your volatility becomes so big on spot volatility. Same thing. These yellow lines are 10% moves. So here is the current strike price, 10% up, 10% down. Look at this expected move window. Well outside a 10% move. So this expected move, now we're talking more like 40, 50, maybe even 60% out here. So, we're trading at 12 and this expected move is up above 17. To the downside, it's down to like 650. In these extreme cases, because this is so far out, and you look at the call strike out here at like 25, that's 100%, 200%. That's double the current price to get all the way out there. Could that happen? Maybe. Clearly, this underlying has some serious call skew. So one of the things that I'll do in situations like this is I will dial back these strikes higher on the delta because I'll try to take advantage of this just uber extended volatility. And let's get, I said I don't mind getting aggressive on the put side. So let's go ahead and take this up to 10 here on the put side, see where that's at. And likewise on the call side, remember, we're out here at 200% move up here on the call side. If you're very conservative, take it. I mean, that's a good ratio there of risk to benefit. A 200% move, you have to go past that before you start to lose money. But I'm going to get a little bit aggressive here, actually really aggressive with my strikes. And I'm going to come all the way into a 1750 here. So if I bring that 25 strike all the way into a 1750, I'm now looking at collecting $3.05, putting up buying power of 712. Let's take a look at what does this do here. So I'll extend this out. You can see here, we still got the yellow markings. This is a 10% move up, 10% move down. My strike is still at like a 40 to 60% move to the upside before you hit that call strike. And so you can see I'm really raking in the premium here. And I'm only putting up $700 in buying power. So I want to hit that target of about, $1,500. If I take this to 3, that's 2,100. That's a little too heavy for my personal taste. So if I take it to 2 contracts, you can see here that I'm going to collect $600, $610 for putting up just $1,400 in buying power. Now, maybe your preference is, oh my gosh, this thing really could move 200%, 300%, and you just want to, err on the side of not that move. So if we take these off and you say, you know what, let's just play it from the put side, which means you have no trouble going up. And there's no problem going too high. And you would take a look at this. And this is a different way you could play it, because when you're dealing with these really volatile things, you could end up on the wrong side of that on the call side if we really take a rocket ship up. And the premium values are really telling you that the market sees a lot of risk to the upside, because that's where all the cost, that's where all the premium is. That's telling you that the options players are betting that this thing's going to the moon, or at least buying options up like that, which triggers that premium to be much higher. Contrary trader, that's where I come in and I sell that. But let's say that's not you, and you just want to take the put side. So we can take that $10 put strike, which was a 27 delta, perfectly respectable strike if you're selling just one side of that. That still gives you a 73% probability of profiting, of winning, I should say, 73% being out of the money. And look at this, you still got your move. You're still collecting $180. You're putting up, $600 in buying power. So the ratio, not quite as much because you're not selling premium on both ends, but you also have zero risk on the upside. That thing could go to, $900 and you would still make the same amount of money. You're not taking on any risk to the upside. Your only risk is to the downside. So, you could trade it that way and shave that off. So let's recap the VERV strangle play. Now, what I wrote down here is the selling both sides. Now, remember, you can tailor that to your risk tolerance. Only do the put side. I never really recommended doing just the call side. It's a little bit risky, and the risk reward ratio is not just for me. It's not right for me. Maybe it's right for you. I doubt it, but to each his own. So what we got here is I got really aggressive here, and I went really to like a 30 delta strangle, which is a very aggressive strangle. I typically am playing a 16 delta strangle, and 20 is pretty aggressive for my risk tolerance. But when we're dealing with a 228% spot volatility, it really kind of, I just want to bring that in because we're talking, expected moves, not expected moves, but your strikes end up being, at 150% move, 200% move. And so I'm kind of comfortable bringing that in for something like this. So here, I sold those at $3.05 each, two of them, $610, and the buying power was about 1,400. Now I rounded up to 1,500 just because that's, what the sizing that I had out there. That's a 40% upside potential on that return on buying power. So, this is something, like I said, this is a riskier one, but I really like this trade. I like the way it sets up, and it's something that I would put out there. It's not as bread and butter as the Goodyear trade because there's a lot more risk in this because of that really, really extended volatility or high volatility. This thing could probably tack on multiple dollars in a single day's move when the volatility is that high. So you have to be careful of that, or at least cognizant of it so it doesn't surprise you. All right, so let's take a look at the last earnings trade that I picked out. And so this is Alteryx. Now, again, Alteryx here it jumped out at me because, the underlying price was 31. We got a IV percentile of 92. Our spot volatility is 93%. So, okay, we got great spot volatility. We're really extended almost at 100%. So let's send that over to our option chain window and see what we can see inside this option chain window. So again, I'm going to come here and bring up simulated trades to look at the chain. Now, again, here we've got just a bunch of monthly options. So, Alteryx had a confirmed earnings of November 6th, but you see I can't actually play the November 10th expiration, which would be that closest Friday. So we just go to the first option chain that includes earnings. And you can see, I could look here and I could say, I bet you the earnings are included in this first one because that's 119% volatility. Then we drop off to 80%, then 67, then 65. So the most volatile chain is likely the one that has earnings. Little trick you can do. So looking here, let's start with my traditional, 16 to 20 delta. I don't see a reason to really deviate from this one, deviate from that strategy here. Maybe I could tighten it up a little bit, but let's just see where we land here. with my rule of 16 to 20. So that'll put me on the 25 strike on the put side. We come over to the call. We got a 13 and we got an 18. So we're going to go ahead and take that 18 delta, which is a $40 strike. So right here, we are collecting a $1.35. We're putting up $445 in buying power, $450 in buying power. We want to get close to that 1,500 for me. So we're probably going to do 4 of these contracts, which are 17. What if we step that down to 3 contracts? That puts us at, 13. I really can't get in there too well, but like I said, let's go 4. What does that get me here on my P&L? So again, we've got our expected move here set to the right thing, November 18th. So that's the expiration of the option chain we have. We got our expected move is staying within the strikes that I chose. So that's good. And we got our 10% move. So this is pretty volatile here because we're talking about another 10%. So this is probably a 20% upside, 20% downside is the expected move. I got a little bit extra buffer on the call side. I kind of like that. The other strike that I could have brought that into, looking back, I could bring that into a 37.50 or a 35. So bringing that call side in from a 40 to a 37.50, I could do that. Takes away some of that buffer, increases the premium I'm collecting, but it's going to take more buying power. So you can see these 4 contracts are now up to 1,900 to pull that in to collect, another $30. So for me, let's back that out to that 40. I don't like that added risk of just for that extra $30. This will take me down to the $1,800. So I'm more comfortable here. So these 4 contracts are going to pick up, $540, and we're going to put up about $1,800 in buying power. Again, we got our expected move is inside my strikes, and then kind of the nice test of the plus minus 10%. Where does that fall? I like this. It's a lot more like the Goodyear trade. So let's summarize the Alteryx trade here. So again, this is very similar to that Goodyear trade where we went into that traditional strangle of the 16 to 20 delta that I like to trade when it comes to earnings. You have to go out to the November 17th expiration because there wasn't a weekly that included it. We're selling their 16 to 20 delta. That put us right at the $25 short put and the $40 short call, about a $1.35 for each contract, targeting a quantity of 4 to bring me close to that, $1,800, $1,500. Like I said, you can tailor that. The percentage of upside is going to be the same whether or not you do 1 contract, 10 contracts, or 1,000 contracts. In this case, the potential upside from that return on buying power reduction is 30%. Very decent, very respectable. This is a trade that I would take, especially given, where the expected move is relative to the price, relative to the strikes. Very comfortable with the risk profile of this for my trading. Again, you're going to have to gauge that for yourself and see where it fits in for your risk tolerance. And that brings us to the end of this week's episode, taking a look at earnings. Like I said, earnings comes around about 4 times a year. They do them quarterly. It is something I love to screen for. They are very quick plays. A lot of times the earnings announcement comes out. You get a lot of movement, a lot of volatility banging around. It starts to settle out. You close out your positions, hopefully for a green. What I'll do in a lot of cases is I choose that week of expiration. And if I'm way off or, I get challenged and breached, I will roll. So I'll try to keep the dream alive in most cases, unless just something looks terrible, and roll that out to give time for that rubber band to kind of come back into the range that it tends to trade in. A lot of times, especially when you got a lot of extra volatility, think of, stretching the rubber band really, really, really hard. And that the tension on that rubber band is your volatility. And so when you got a lot of tension on that rubber band and you let all the tension out, that rubber band really moves. It contracts a lot. It might extend one way real far, but a lot of times that rubber band will tend to gravitate back to a mean state. And that's really what this earnings trade is about. It's why we play the strangle on both ends. We're looking for that real stretched rubber band to zing up, zing down, kind of bounce around, but we're looking for that to start settling in somewhere inside that really wide net that we cast. And you have to do that wide net casting when volatility is at an all-time high, because if you don't, you can't get that far away from the current price and still collect decent premium. It just becomes extremely hard to do. If you don't believe me, do exactly what I had in my screener, but switch the reversal and look at the lowest IV percentile first and try to craft yourself a strangle around the lowest IV percentile. And you'll see exactly what I'm talking about, that lack of premium, that lack of volatility just creates a very bad situation for trying to collect good premium at a far enough distance away from the current price. So hopefully you found this informative. This is the type of thinking and analysis that I do before I enter a lot of my earnings trades. You know, even if earnings trades aren't your thing, hopefully you're finding what you like to trade out there in the market. There's a lot of opportunity. There always is a lot of opportunity. So don't be afraid to take advantage of it. And remember, think outside the block.